Hey everyone. This week's main topic is inflation, since we have a new CPI print this week, PPI tomorrow, and CPI on Wednesday. My thesis is that inflation will be coming back uh, very, very soon. We should be seeing a tick up starting either this month or next month, and the potential is for it to go quite big. It depends who wins the election as well, but not that much because regardless of who wins in the US, they will have inflationary policies. And what is surprising is the fact that inflation dropped so much in the US, not that it's coming back up. And first, inflation is money losing value and real assets gaining in value. One of those real assets is stocks. And this is US CPI year over year, and it's offset by 5 months. The exact offset is hard to pinpoint, something between 3 to 6 months, like 4, 5, 6. I don't know exactly. I put like a -5 just for how good it fits, and it's somewhere in between 3 and 6. And we can see clearly that when including this offset, when inflation goes up, stocks usually go up. There are some exceptions, obviously, but more than likely when inflation goes down, stocks usually go down. There are some exception periods, but this is generally true. And what we see here, for example, is that we had a drop in inflation, we have a huge rally in stocks, meaning this is an anticipatory move that inflation is coming back. This could take many forms, and it doesn't necessarily mean it's bad for stocks, and I'll detail that when we get to that point. But for now, the idea is that inflation should be coming back and in force unless uh, interest rates are hell high. And I think the worst possible outcome for the market in the immediate future is that we have a hot inflation print and all the hopes of Fed cuts, which are now getting to 4 or 5 cuts this year priced in, get shattered. If this happens, basically stocks will have to catch up with this part, meaning this was a fake move, and it will have to catch up with what inflation has been doing. But I doubt that will happen because the Fed will blink. Even in maybe we get a short-term reaction that takes us lower, obviously, but longer term, meaning longer term, 3 months out, the Fed will be blinking and stocks will go back up for now at least. Okay, so we see this correlation, and we see that expectation is for stocks to go up. Let's look at some other asset classes. Let's look at oil. Oops. And same kind of thing when people expect inflation to go up, the correlation is even better. Usually, oil goes up. What I found though is that oils usually follows, not leads in this. So if inflation is coming back up, we should see oil break out to the upside here. We have a pennant built up, and we should see oil move and break out if the Fed does nothing and uh, caves in the face of rising inflation, but even slowing growth. Then let's look at copper, which copper is more of a lead. And we see copper went up, but inflation didn't go up. Let's look at Bitcoin. Bitcoin is basically the same as stocks, but it has a very good correlation with the inflation rate. And again, it went up a lot and nothing happened. And I saved a bunch of economic data or indexes that are should be relevant for the discussion. And we start with the global supply chain index. And the theme here is that everything has bottomed more or less. Like if you ask me from a technical analysis perspective, this is a classic lower high, not lower high, higher low that will take us to a move significantly higher. Basically, what SPY did in on a daily basis, like this. So what we're seeing here in the supply chain index is basically this part here, not this part, this part. So basically we went up, we made a higher low, and maybe we get retested, but eventually this will lead to a breakout. And this looks similar to what we will be getting soon in the supply chain index. Then we have the car prices here, the Manheim used car prices, which is correlated with the inflation rate quite well. Uh, Not necessarily here, but the month-over-month chart is very highly correlated, especially on short-term moves. And the print this month was 2.8 higher, even though like if we zoom out like this, we are still very low. But the fact is that we have bottomed and we're starting going up again, and it's very likely that the move up will be sustained. Same for the supply chain index, is still relatively low from historical perspective, but that's not the point here. The point is that we have started going up again, and it's likely to continue going up. Then we have a bunch of economic data. This is United States import prices year over year, and same kind of picture here. We clearly have bottomed. We made a higher low. We're still going up. Even if we get like a negative print, this is more like a bottom than like the likelihood of continuing down here and continue the disinflationary trend is very, very low. So we should be seeing this go up again very, very soon. And on a month-over-month basis, we keep seeing the same kind of thing. This is slowly going up, making higher lows. It's clearly the beginning of an uptrend, and very likely it will continue going up. And it's divergent with the inflation rate. So I would expect us to get a tick up in inflation this month or the next month. Then we have gasoline prices, which because they are tied to oil, they are more follow than a lead, and we can clearly see this here. Like if gasoline went higher quicker. In this scenario here, it also looks like a bottom, which is strange given that inflation is much lower, but also pointing towards a move higher together with oil. Then this is the price personal PCE expenditure excluding energy and housing, and this is month over month. Don't remember exactly. But what I wanted to show with this one is there are two critical levels. One is 0.2 and the other one is 0.6. When we are in the above 0.2, we get a spike in inflation. When we are above 0.6, we get a huge spike in inflation. And uh, coming from a low, like we dropped, we went higher, we're still kind of making a higher low here, and coming from a low, it's concerning that we're seeing these kinds of prints. And again, we have been above 0.2 for a while. It doesn't look like we'll be going below 0.2. So the only way we could be going is up. But periods in which we stay above 0.2, as you can see constantly, as you can see, there are correlated with periods in which inflation is going up, not down. Then we have all the manufacturing prices prints have been, again, looks like a bottom. You can get lows from time to time. Uh, we can get prints that go lower, but it doesn't change the trend. The trend is that we will likely be going higher. And you can see that it's highly correlated with the inflation rate, with the offset inflation rate of 5 months in this case. Just a number of things. So this is ISM manufacturing prices. Then we have transportation prices. This unfortunately is lagging. The last print was from April. So I would expect this to also confirm the trend of making higher lows. I don't know exactly when the next print will be, but we didn't even get this part here when we had a spike up, potentially a lower high in inflation, and then move back down. Then we have core producer prices year over year. again, bottom, we're going higher. This is still going lower, a divergence that should be concerning at least in for a while. Then we have producer prices year over year, same kind of picture. It's very similar to that previous chart, and we have bottomed. We're going back higher. This is some regional Fed prints as well. This is Kansas Fed. Again, looks like a bottom. We should be going higher soon. This is New York Empire State prices. Same kind of picture. They kind of look the same. Double bottom here. We go up, turn this level into support. Should be going higher. Then Dallas Fed Manufacturing Prices Paid Index. Same picture. We're going higher. And Philly Fed Prices Paid. We have made a low here. Now we're going higher. And this is kind of the common picture across the board. And it's kind of to be expected. Like I said, the surprising thing is that we actually dropped so much in CPI, and from what I can tell, the major aspect of it was energy prices, which have come down. But again, we should be seeing a tick up in inflation either this month or the next month for sure. If it's not this month, it should be the next month. And all the drop in yields, which have recovered a bit due to the yen intervention, should be going back higher. The market will get scared of the Fed not cutting, and there's the potential for us to get a very ugly reaction from stocks. And another reason why inflation could continue dropping or is not coming back up is who absorbs the costs. Because up until now, the costs have mostly been absorbed by the consumers, but the consumers are pushing back. We saw lots of comments about this in earnings calls this season, and we could continue having a drop in inflation, or at least not get a move up yet, if the costs are absorbed by the producers. Their costs going up. If the prices are going up, someone has to take on the cost. It's either the consumer or the producer. If the producers accept these cuts, it means they hit their own margins, but prices don't really go up. But in either scenario, meaning inflation goes up, the market gets a scare, and the all the cuts get priced out again. It's very bad for stocks. But if the producers accept the cost themselves, it's very bad for stocks, but not immediately. It will be bad for stocks at some point in the future, one of the next couple of earnings seasons. Probably not the next one either, although the next one will be a bit more shaky as well. But the one after that, where it will become visible that they had to absorb more cost and their margins are getting hit. So what happens next or this week depends a lot on the CPI print. It's possible that we get an early reaction because if CPI doesn't go up, so I'm on SPY. Actually, let's move to Qs because it's more interesting. So the PPI print is here. PPI, I believe, started going up already. Let's see. Sir price index. Yes. It's PPI. Look at this one. Doesn't seem so. PPI. Year over year. Oh, no, it did. So we see PPI started going up already. And again, this should be visible in CPI with a couple of months of delay. It might be this month because it started going up again in June. So we have, in June 2023. That's a lot of time, a long time ago. So we should be seeing the increase move into CPI relatively soon. Now, if that happens, all hell can break loose. Like we can get to the 20% correction that I said could happen, but it could also be just a bottom retest. It's difficult to evaluate. It depends on the how hot the print is or if it's hot at all, uh, and how the market reacts to it. Like if it it's complicated because there's a level of nuance in the reaction or in the interpretation of the thing. One reaction could be, oh my god, the Fed won't cut, so we are fucked, and higher for longer, and the Fed won't cut, and that will make stocks crater basically. And I think there's possible that we get 20%. And there's the next level thing, which is, oh my god, the Fed won't cut, let's push stocks down. And then when, oh my god, the stocks are down, the Fed will cut again. So it's this holding two ideas in your head, double think kind of scenario in which the market can react in very strange ways. What the strange way I'm thinking one would be one low retest, like 413, 410, we go back up. The other one being a much going much lower and then bouncing due to mechanical reason or whatnot. So this one and the next one are once again the most important CPI prints of our lives. This time a bit more real than in the past, and I think the market is as a major turning point. The chances of us rallying from here in a substantial way without going lower first are minimal. I think we will get a reaction here even if we go up. The chances of going up are very small in my opinion. Today it can be just like a slow grind up because of mechanical reasons with some putty hedging. But if the market gets scared again, we can see another VIX blow up. Uh, Not that high, but like 30, 40 is possible. Make a lower high and then start going up again. But it depends a lot on the next couple of prints. Imagine like if the CPI starts turning up this month, it's very doubtful that it will stop going up next month. So what's the reason for the market to go up unless the Fed signals that they will be cutting in spite of CPI going up? If that happens, and if that happens, it should come around Jackson Hole, so probably this week, I think. When is Jackson Hole? Jackson Hole Symposium 2024. 2020, 22nd, 24th. So, it's quite close. So this week. So we get the hot CPI print, let's say. The Fed then backs down or commits to keeping rates high. If the Fed confirms that maybe this CPI print is hot and we're not cutting in September or something like that, then all hell breaks loose and the market probably does 20% correction. If they are accommodative and say, okay, we got a hot CPI print, we're in spite of that, we're committed to cutting 25 basis points in September. The market will still not like that very much, but it's enough to get us a short-term bounce here. But then again, if in September we get another hot CPI print, then the market is gonna be fucked, and we probably get a 20% in September because the Fed will definitely not cut more than 25 basis points if we get another hot CPI print. And even if we do get a hot CPI print, they probably gonna say something like, okay, we cut now because reasons, and we're gonna do another cut in December of another 25 basis points. That's way lower than the market believes right now, and it will get really scared. So my basis for the hot CPI print and continuation in that hot CPI print is 20% correction, which I think I drew it somewhere. I think on CPX. Yeah, on SPX. This is playing out pretty nicely. It's this, so 450. This is 20%. 445, 33. This is 20% on SPY. And again, don't imagine this will be very fast, like and we will get rallies in this correction, but we will keep the downtrend, and it will be there for a while, and we go up, we probably get rejected at the trend line, and so on and so on and so on, something like this. And this is not drawn well. Like I expect that if we get a really hot print this month, it will be like 10% in 3 days, which is something like this. So this looks very clean and elegant from a TA perspective, but it won't be like this. It would be fast and brutal. We go down 10%, we bounce 5-8%, we go down again when the next event happens, and so on. So I'm not going to be holding either short or long positions for CPI, but if the initial reaction is negative for the CPI print, I am going short, buying some short-term puts, and ride those at least for the low retest, but probably much lower than that, depending on the amplitude of the move and how impulsive it is. Yeah, so that's kind of it for this week. Hope it helps you guys. Have a good one. Bye bye.